Those tests not only have an impact on people looking to buy a home, also those looking to refinance a mortgage that they already have. That is the new landscape for Canadians. I spoke earlier about that with Samantha Brookes, the CEO of Mortgages of Canada. I asked her what people need to be thinking about.
Anyone who currently owns a home needs to make sure that they're mitigating their risk. So that's the most important thing for anyone that I meet right now. If you own a home, make sure you review your budget, do a mortgage review, add an extra 20 to 25% to your payments, and just make sure that it's not going to be a pinch later on down the road.
Now that's the key. When you meet with people, and here's the idea of it not being a pinch further on down the road, that's the whole point of the stress test, at least what Ottawa tells us, that if you can afford the mortgage at 200 basis points higher, then we're not too worried about you being a risk. You say you meet with these people, how concerned are they about that they can no longer even get into the market because they can't qualify under that test?
Well, it's not even so much that they can't really qualify. It's just that the market itself is still very high. So with the new stress tests that have been put into place, so I call it the first and the second. So the second one is really the one that we have to be concerned about because it's going to be taking away an additional 20% of the borrowing capacity. If you have a home on the market that's worth $800,000, anyone that was previously pre-approved at $800,000 can no longer buy that home. So if you're selling that house, you don't have a buyer. You have to bring the house prices down in order to meet the buyer. And so the house prices will then come down. So it's not so much that you cannot afford it, it's just that you have to know how much you can afford.
The people who are coming to you at the same time, are they a little bit shocked when you run the new numbers for them? Because, you know, people can go on, when they start thinking about they want to buy a home. I can think of what I did when I was still a renter, and you play with the little online calculator and say, oh, we could buy this much house. Are they shocked when you show them the new numbers? They say, wait a minute, only this much house?
Yeah, a lot of them are shocked. But you know what the good thing is, though, Greg, is that they can actually negotiate. So right now, a house may be listed for about $600,000. It could have been sitting for the last 30 days. They're able to go in and negotiate that price. And as long as the client is pre-approved and they're able to afford that property, they can get that home.
One thing about the stress test, of course, is this is from OSFI, which regulates the big banks, but the credit unions don't have to abide by these rules, and apparently they decided they're not going to put those tests in place. Are you starting to see people move, or at least curious, saying, I don't know, not sure if I want to go through a big bank, maybe I can go through a credit union or somewhere else?
Well, it just depends. So what we do is that we review the whole application. We want to see the whole financial picture. So we're looking at their credit, we're looking at income, we're looking at anything that can get in the way of them fitting in with the big bank. And if they do not fit in the big bank, then we're going to look for an alternative lender, whether it is a credit union, whether it's an alternative lender, or even sometimes private. Just depends. If people are not showing any type of income, then the only way for them to go is through a private mortgage. So it's just making sure that they understand what's available to them before they actually dive in and go sign off on financing before they know their finances.
Of course, if you go to a private lender because you can't show income, maybe you're self-employed, you're not at risk, but still you can't qualify under the big bank, you have to pay a much higher rate of interest. My understanding is that when people get into those products, they want it to be for a short term, maybe 6 months, maybe a year, until they can get into a more conventional mortgage. Is that sort of the way you plan it for them?
That's exactly it. It's usually, as you said, 6 months to a year, sometimes 18 months. It just depends on what their financial picture is and how quickly we can get them out of that. We call it our temporary solution. So you have to have a solution whenever a home buyer or a homeowner comes to you and they no longer fit within the traditional lending requirements.
Now we're hearing anecdotally, and in some cases actually through some numbers that are coming out through real estate boards, that there was a rush to market in November and December. People were aware of the rule changes. They wanted to get in beforehand. Did you see any of that sort of,
we did.
A lot of activity ramping up?
Absolutely, we did. We saw a lot. Actually, we started seeing it in October. So we just prepared all our clients. Obviously, they were coming because everyone wanted to make sure that they were able to get in before the rule changes. And some banks are actually holding those pre-approvals, but some are not. And they're only holding the rate, but not necessarily the actual rule. So you just have to be careful where you got your pre-approval.
You say people come in and you look at the full plan for them and their economic situation. We're starting to get concerns that people's household finances are deteriorating somewhat because they've borrowed a lot in the past couple of years. Either it was to get into real estate or to get into recreational properties. When you look at the health of the people coming in looking to do business with you, do they seem like they're on a sound footing, or are there some problem signs?
There's definitely some problem signs. A lot of our clients who come in refinancing, they're coming in with a lot of debt. You know, for an average person, it seems like it's around $40,000 to $50,000 just for a working family. That's quite a bit. They're living on their credit cards, right? So when, if there are increases in the rates, then their cash flow becomes limited. And I tell people, if you start feeling that pinch, the most important thing for you to do is to make sure that you don't ever miss your mortgage payment. I don't care if you want to miss your credit card payment, but do not miss your mortgage payment. It's also reporting on your credit bureau. Banks are reluctant to renew if you've missed a mortgage payment.
Fascinating stuff. Thanks for joining us.
Thanks for having me.